Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 164 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How are you doing, my friend?
Oh, good, Andy. I'm very good this week because Tottenham beat Man United at home, so I was very pleased. As people know, I go to all the home games. That cheered me up. But the only downside to my week is I went to see Chris Rock, the comedian, at the O2. And, I mean, the parking, Andy, I don't get out enough, clearly, because the charge for the parking, £34 just to park my car for a couple of hours.
Well, one thing I've got to say to you is, what are you doing driving to the O2? I mean, surely that's... You deserve it for even attempting that.
Well, the thing is, I don't actually live that far from it, so... If I didn't, it would be slightly convoluted, but you're right. In hindsight, I'd have been better off not driving to the O2, and yeah, I couldn't believe it. So I've not quite recovered from that, even though that was almost a week ago. Apart from that, yeah, fine. The United game cheered me up. But what about you? You good, Andy?
Well, if we're going down the football route, then no, I'm not all right, actually. I went to see my team play last weekend. Watford in the FA Cup went down to Southampton in the rain and the cold, and it was our manager's first game, and we conceded after 2 minutes, and it pretty much got worse from there on in. So it was awful, yeah. And I went to see the football on my own for the first time in a very long time. And yeah, it's a bit of a strange experience not being able to chat about the game to someone next to you, and actually just getting some funny looks from the people around you thinking, oh God, that's one of those weirdos that goes to football on his own. So yeah, it was. I mean, I'm sure I'll have nightmares about that weekend in years to come. So it wasn't good, but
yeah, and you couldn't even drown your sorrows or anything, could you? So no. I mean, yeah. But sorry to hear that, Andy. But
that's okay. We'll get over it.
There's no sympathy in what I'm saying at all. But because the only reason I say that quickly before we move on, because I've got so much to do this week in the podcast, I've got to cram it in. Is there was a guy who there's often a spare seat near me where I sit in at Wembley. And it fascinates me who sits there, just a person on their own, because it seems to be in between season ticket holders, a random seat. And sometimes you see somebody sit in that seat who is longingly looking at their friends about 4 rows down, who is to say, I'm with them. But just every now and then there's a person like you, Andy. And I always wonder a lot about that person.
What brought them to this place right now to be sitting at football on their own? Yeah, well, that was me. Damien, let me get rid my mind of those awful memories, and let's talk about today's pod. What have we got coming up?
Well, before we do that, Andy, the only thing I want to quickly go on to is reviews. And we've had a flurry of reviews, and one of them, I think you mentioned last week, it was actually JM again. I'm going to read out bits of it because they gave us a glowing review about how they loved our honest style, and it's a bit like being down the pub and me and you talking. And at the end he says that, P.S. if you read your reviews on your shows like other podcasts, you might get more. And of course we did, and what happened? We got more. So a couple of others on there, I'll read them out. Ollie B81, this gem of a podcast is perfect for the British listener keen to optimise their finances. The delivery is clear and accessible, and content highly relevant and practical. It's brilliant. That's a 5-star review. The next 5-star review was Knit Nurse. I don't know if that's meant to be night nurse, but I don't think it is. It's spelled N-I-T, so Knit Nurse. I hope that is not their day job, but informative and interesting. 5 stars. Thought this might be a bit of a dry podcast considering the subject matter, but it's not at all. It was informative and interesting, covering a range of topics with a good presenting style. I've been getting the newsletters for a while now, but not listened to the podcast before, but I will now, ! So there you go. Give us reviews, we'll read them out, and who knows, I mean, we read out some last week and people got in touch on Twitter to say it made their day to hear their review read out. So on with the podcast.
Good. So what have we got coming up on this week? What are we going to cover?
I'm going to be ambitious because I'm trying to cram so much into this podcast, and we're a few minutes in. The first thing I want to do, a couple of weeks ago I mentioned about China and America, and how China is actually America's bank manager, and some people might not understand quite how that works. And it's a bit of an economics number, and I'm going to be ambitious and try to explain this concept on this podcast. And there's going to be a range of things I'm going to explain to you in order to get there, building blocks to get you to understand why, and to understand why Trump's tweets ultimately impact your pension. It's an ambitious piece. I'm going to do it, so you're going to have to engage your brain, but I hope that we're going to be able to pull this one off, and you'll be buzzing when you get to work and you want to tell everybody about it. Similarly, there's another piece we're doing on a really good piece on car insurance. There's been a pulled together lots of bits and pieces about research that's been done on the quirks that impact your car insurance that can make it cheaper or more expensive, from the bizarre in terms of gadgets to slightly more mundane like mileage. But there's some really interesting things in here that even I didn't know impact your premium and influence how much you'll pay a year. So these are the sorts of things you're going to brag about down the pub, maybe. You'd probably talk about football maybe, but if you were going to talk about car insurance and sort of try and get one up on someone, then these are the sorts of bits. And the final thing is on investing. There's a new legislation that's come in thanks to the European Union, which covers costs. So if you invest at all, this is important. You need to listen to this piece. I'm going to explain around costs and how much funds cost to invest in, why that's changing and the way it's reported.
Good. Okay, so what should we start with?
Let's start with China and why China is America's bank manager. Like I said, it's an ambitious piece, and if it goes wrong, we'll delete it off the podcast, and no one will be none the wiser.
We'll say no more.
We'll say no more. We can start again. So I'm going to take you through this, Andy. As ever, ask questions, stop me, ask me what I'm wittering on, or give another explanation. So
I'd like to say that I'd play dumb, but I don't even have to play the part. I will be dumb, so I will ask those questions.
Ask away. So there are a couple of building blocks to this you need to understand. Now, in order to understand why or how countries work, I always like to try and use yourself as an example. So think of yourself as a country. And if you understand how your finances work, you can go a long way to understand how economics works and how countries work. So why is it that actually China controls a lot of what goes on in America's economy? And people might not know this. The first thing you need to realise that if you are a country, so like America, like the UK, you won't make as much money as you need to spend. A bit like you and I, Andy. You go to work and you earn money, but you might spend more than you actually bring in. Countries work the same, so they have to borrow money to actually function. If you're going to have big infrastructure projects, you're going to need to borrow money. Now, the first thing to bear in mind, how do they do that? Now, if you think about when you buy a house, Andy, you take out a mortgage, and probably the simplest from capital expenditure from your point is an interest-only mortgage. So governments do a similar thing, and they're called gilts in the UK and treasuries, US treasuries in America. And the way they work is they will borrow a fixed amount of money, we'll say £100,000 to keep it simple, and in return for that £100,000 that they borrow, they will pay you an interest amount every year, which is called the coupon, but it's an interest amount every year, a bit like an interest-only mortgage, and then at the end, they pay you back the lump sum. So they do that, but they do that with trillions and trillions and trillions of dollars worth, and they have various lengths of time that has to be repaid, like a mortgage. You can have 20-year mortgages, 30-year mortgages. So the key thing is countries borrow money by using these instruments, and they're traded. So people will invest in treasuries or gilts, and companies do the similar thing, and it's called bonds. That's why you hear about bonds. Now, if you think about it, if you want to buy these things, then you're pretty certain the government's going to pay you back if it's the UK or if it's America. So you don't get a very great or high level of interest, but they are better than cash. There is a risk that you won't get your money back, so it's not as safe as cash, but let's be honest, the government, so you're going to get your money back. Now you can see, if you try to imagine, if the government is borrowing money over long periods of time at a given interest rate, now that interest rate is we're going to call the yield. Okay, yield is based upon the amount of income you get versus the price you pay. So if you think about houses with rent, the rent versus the price you pay is called the yield. So what happens is this amount of money that they can borrow, the government, has a particular interest rate, and for investors, when they buy and sell these gilts or treasuries, they get a yield. And when you think about this, it's important what rate the government can borrow money at, because if you imagine in America, if they can borrow money at a certain percentage, then that is going to be the basis for all other interest rates in the country. So, for example, mortgages. Let's be honest, Andy, no one's going to lend you money at an interest rate lower than they will do the UK government. So they think you might not pay it back. So what happens is the rate at which gilts and treasuries are pay back their interest rate, that is the base level, and everything else is based off of that, so it's slightly higher. So it's a really important interest rate measure within the UK economy. And of course we have our base rate in the UK, and America have their own version, which is more to do with the near-term interest rate, so over the next couple of years. It's more immediate. Whereas with these long-term loans, these treasuries in America, they tend to influence some of the longer-term borrowings for companies and individuals and stuff like that. So they're really important. And if those rates go up, that makes it more expensive to borrow money in the economy. So you've got that.
Got it.
So I'm pleased. You've just understood a really important economic concept. So for countries that want their economy to grow because it's not doing very well, they want those rates to be low. If the economy is going too fast, it's going to blow up, they will start to raise those rates. It will start to cool things off. And like I say, think about your own bank accounts and things like your own finances. When interest rates go up, so when mortgage rates start to go up as a result, you will start having less money and you won't spend so much. You'll start thinking, well, I'll start to save that for a rainy day, especially now as the interest rate on my savings account is going up. So you stop buying things, which is not very good for the economy, and you start hoarding your money. And that's the cycle of how it works. And that's called tightening, monetary tightening. So we are in the world now where we've had really loose conditions where rates have been generally low, and we're starting to try and tighten those and get our economy to be able to stand on its own 2 feet. Now, of course, those instruments I said, the treasuries, can be bought and sold by people because they eventually are like investments, and so you can put your money to work by lending it to the government. Now, the yield or that people get on their investment depends on the rate they buy it at. So they won't always be the same price. Imagine like a house, the prices will go up and down due to supply and demand. But if you imagine on a house, when the price goes up and down, imagine if the rent was always fixed on a house, it was always the same. So the yield you got based upon what you bought would vary, wouldn't it, depending on the price?
Yeah.
So with treasuries and gilts and things like that, the interest rate the government is going to pay when they sort of take out this loan is fixed. They're always normally fixed. They don't tend to increase. So you can see, therefore, this is the next important concept, if everybody started buying all these treasuries and gilts, it would mean that the price would go up because of demand, but because of the way they're priced, the yield would actually fall. So the return that investors are getting is going to start to fall based on how much they've paid, because the interest rates are fixed. Does that make sense?
It does indeed.
So that means if you therefore just sit back and think of that in the round, if the government then decided, I want to issue some more of these treasuries or gilts and things like that, i.e. borrow some more money, then the going rate in the economy would be quite low if the demand was really high, because people are expecting a very low yield now. So you can see that actually dictates the level at which the government can borrow, so this supply and demand metric. So you've understood 2 very important things here, Andy. So when people really buy lots of these treasuries and bonds, the rate at which the governments can therefore borrow new money, effectively, starts to fall because the yield that investors are getting is quite low.
Got it.
Now you've got those 2 concepts, park them to one side. Now, imagine that you're China and I'm America. As a country, you would quite like to run what they call a trade surplus. So if you want to be competitive and make lots of money, you want to export more than you import, because therefore you are making money effectively. I'm oversimplifying it, but this is what it boils down to. So as China has a trade surplus to America, so therefore it makes things, lots of things are made in China and export it to America, but they don't import as much from America. Now, you might hear Donald Trump doesn't like this kind of stuff. He wants to be self-sufficient, and he wants everyone to buy America and all that kind of thing. He doesn't like the fact that they're reliant on China. So as a country, Andy, where you are is you might think, I want to sell more stuff to the rest of the world so we can export loads of goods. Now, one way to do that is to make your goods cheaper than anybody else. And therefore, everybody, when they're like globally sitting around looking to buy something, they look, oh, well, the ones in China are cheaper. And part of the way that can occur is if your currency is very weak. And you may remember when the pound fell through the floor after Brexit, we talked about how exporters actually benefited from that because suddenly everything that they made was therefore cheaper in the eyes of someone over abroad because their currency got stronger. Don't forget, currencies move in opposition to each other, like a seesaw. When one goes down, the other goes up.
Yeah.
So if you were China, you'd be quite keen to make your currency cheap because if yours is really cheap, then if you make something that America can make or another country can make, in the eyes of the world, yours is the best value because their currency in their own value can buy more of your Chinese yuan, is the currency in China, products. So one way to do that is print loads of money. Print loads and loads and loads of it. Because if you print loads of money, just think if it's loads of money washing around, it's not really worth anything. But of course, the problem is you could do that, but you also would like to make the dollar stronger as well. Because that would actually have an advantage for you, wouldn't it? Because if you make yours weaker, but you also make theirs stronger at the same time, then that would actually make it even more of a benefit, more of a boost.
Yeah, you're doubling up.
You're doubling up. So your exports are looking even cheaper than America's exports to the rest of the world. So you're going to be looking really good. And even people in America are thinking, do you know what, I'm going to just buy abroad, it's cheaper. So what they do is if you were China, you would print loads and loads of money and you'd buy lots and lots of dollars because the way currencies work is if you printed loads of Chinese yuans and bought loads and loads of my dollars, then it's again supply and demand. What happens is the currency exchange starts to work in your favour. My currency gets stronger because of the demand of buying them. Yours gets weaker because there's loads of it everywhere that you're just printing and no one's got them. So, of course, that's what happens. So, therefore, they are, in effect, in a currency war. Now, that's another interesting economic concept that you've understood. Am I right, Andy? You've got that so far?
I'm absolutely with that.
So now, imagine if you're China and you've printed all your money, your own money, and you're sitting there and you've bought dollars. Well, would you really want to buy dollars? Because if you buy a currency, you don't really earn any money. You've just got a pile of money sitting there. So you've got, and we're talking trillions and trillions and trillions of dollars of this stuff. So you think, actually, I'd like to get a return on that. What else could I buy? And you look around and you think, do you know what? US treasuries, you know those things we were talking about at the beginning that are in dollar terms. So you think, do you know what, I'm going to buy loads of that, and if I buy loads of that, then I'm going to get an interest rate on it. So instead of having dollars, they buy trillions and trillions and trillions of pounds worth of these treasuries, which are essentially loans to the American government. And now you can see that as they're buying lots and lots and lots of them, the yield on those treasuries is going down because of that supply-demand metric, which means that actually for Americans' government, they can borrow money at a lower rate. They might not realise it's in fact because China's buying all of their money or effectively loaning the American government loads of money. So that's where we are. But what's really interesting is that what happens when China one day decides, do you know what? I don't like the fact that Trump keeps tweeting all this stuff about us. I don't like the fact that Trump is now going to impose tariffs on our exports to try and put America first and make America great again. Let's sell loads of these treasuries. Let's unwind all this. We've got loads of it. Let's start selling it into the market. And what happens if you were to do that, if China was to suddenly flood the market with all these treasuries, then we work backwards through that whole cycle I've just described. And it would work in kind of like this. You would put loads into the market. It would drive up the supply. So therefore, what will happen is the price of those treasuries would fall. So it's a bit like house prices suddenly plummeting because there's suddenly loads of houses. Then what it means is that the going rate of the yield that investors get on it will start, because of the way bonds are priced and treasuries are priced, will start to go up. And therefore, if America wants to suddenly borrow more money, the rate at which they borrow will start to go up. Or in other words, to cut a very long story short, it drives up the interest rate in the American economy. And America can't do anything about it. The Federal Reserve can't do anything about it. So if China did that, what they'd effectively be doing is pushing up interest rates in the American economy, which would make mortgages more expensive for average consumers. It would make borrowing money for businesses more expensive. It would make America's ability to borrow money more expensive. And in effect, that would then start to slow their economy. So it's a bit like, if you upset your bank manager, he suddenly goes, you know what, I'm going to whack the interest rate up on your mortgage because you've just upset me. And China now, because of this years and years and years of them buying all these treasuries, they have that ability if they wanted to. And in fact, in January this year, there was an unofficial leak which stated that China was going to start doing that. And it caused a big wobble in markets because they suddenly thought, oh my God, what's going to happen if they do sell them? And of course, there is that question, could they really sell that many in the market? Because they are one of the biggest holders of all this stuff. But what it means is it just highlights the fact that China could, if they wanted to, start to tighten the screws on the American economy without Donald Trump doing anything about it. So it's really interesting when you watch politics and all these things, and you see Donald Trump, he starts attacking China, and then suddenly he occasionally becomes a little bit more considered and a little bit more, what's the word, sort of appeasing of China. And I think it's a bit of flexing muscles from China just to say, yeah, do you know what, we are your bank manager, and all your companies and everything, we lend them money, and do you know what, we can influence you in ways that you can't us. So it's very interesting, and of course that's why ultimately things that Donald Trump does impacts your pension, because if all the treasuries start to plummet in price, that means bond markets collapse, which is what pension funds tend to buy, and when bond markets really collapse, equity markets also get a bit spooked. So in a roundabout way, I hope I've managed to give you a bit of an economics 101, but if you've come most of that journey with me, you have understood a hell of a lot of quite complicated economic principles, but you haven't had to go to uni to do it. So there you go. It just like to bring the relevance of the news you see on telly and how it impacts you. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service, let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so what we got coming up next?
Right, we've got two fairly quick pieces now, but no less interesting. The first one I want to go on is car insurance. Now, we all have car insurance, Andy, and it's a bit of a roundup of some of the research that's out there that's been done into the quirks of car insurance, and I'm going to pretty much rattle through them, and it's a bit of a did you know element of car insurance. So let's kick off with gadgets. Now, everyone likes a gadget, but did you know that having a expensive sat-nav installed in your car could drive up your car insurance?
No idea.
Apparently the logic behind that is because someone might break in and steal it. But did you know that if you have a new exhaust put on your car, it could drive up your policy by £100 on a typical £500 policy? So that's a that's a 20% increase in premium. And now when I say new exhaust, it's not just the one that the car has by standard, but if it's a slightly tweaked one that might be seen to boost performance, then doing so can raise your premium. But the one that I like most about these weird customizations is stickers. Did you know that if you put stickers on your car, they could, according to the AA, push up your insurance premium? And
how would they find out about that? Because that's not a standard question on the form, surely.
No, it's not. But I'm guessing if they came and looked at your car and there was a "Jesus loves you" sticker on your car, then they might question what happened. Because I joke, but the fact is, religious stickers, it's not about national trust or anything like that. If you had a particular sticker that could invoke some form of, I don't know, confrontation with somebody else, they view it as an increased chance that you could make a claim. I don't know, maybe someone, maybe not driving into you, but scratching your car or something like that. And they even think religious stickers could be that. So, there you go. A quirk that I've never heard of, but according to the AA, that can happen. But on the equal side, you can get discounts for gadgets, dash cams. If you have a dash cam, apparently that can knock down your premium. And the logic behind that one is that it can speed up the claim time, and it can actually reduce the costs as well, because they can see everything that occurred and see the damage. So that's quite an interesting one. And a tow bar. Who would have thought having a tow bar on the back of your car could cut your insurance premium by a fifth? Now, could you even guess the logic as to why a tow bar could cut your car insurance, Andy?
No, I was thinking the opposite, that it might drive it up, because if you've got a tow bar, you might be keen to tow someone else. And if you've ever towed anyone or been towed, you might know how complex and stressful that is. No, I've got no idea. Tell me, how does that work?
I thought, like you, a tow bar you're likely to be doing all sorts of crazy manoeuvres, towing something. And the logic of this one is apparently because if you tow something, you are limited about the speed at which you can go. So therefore, on the motorway, you can only go a certain speed, which someone can correct me, which I think is about 50 or 60. So therefore, that's the logic on that one. The other thing is, did you know that your credit score can influence your premium? Now, we've spoken previously about if you pay monthly, there's an element of credit interest on your premiums. That's why if you multiply your monthly premiums by 12, they don't equal an annual premium. You get a discount, effectively, for paying annually because they don't credit check you and you're not taking out a form of credit. But even if you do take out an annual policy, they can do a soft search on your credit report, which doesn't leave a mark. It doesn't stop you getting a mortgage or anything like that. But they might use the data on there to assess how you run your finances. And the logic behind that is that if you struggle with your finances, then you may decide to make a fraudulent claim or not be able to afford your excess or to pay for any damage repairs. So again, all very judgmental, but this is the risk analysis that goes into most insurances. We've covered car insurance massaging on the podcast probably about 3 years ago, but that is where you can change your job title. And so you could be doing the same job, but your job title could be different and it can affect your premium because the insurance companies make an assessment based on your risk. So you can play around with your job title and change it. I did a whole bit of research once for the Telegraph on this, but give you an example, construction workers would pay £682 a year, whereas a bricklayer, which can be effectively the same thing, will pay £607, which is a big difference. The other thing is, if your name's Mohammed, that might be unlucky, which is actually illegal. Now, this was a slightly unusual one. There was a newspaper, I forget which newspaper it was. It would have been the Mail or the Sun. They were doing lots of stuff around this. And they did a bit of research into looking at whether names can influence your car insurance premium. They're not allowed to, and your gender isn't supposed to either. But they still found that if they put in the name Mohammed, it increased the insurance premium by £1,000, which has been denied by the insurers. But I can only say what the research shows, which is outrageous if it's true. I'll rattle through the last few other quirks. The time you buy insurance is going to have a big difference. If you're renewing your premium, then if you buy your car insurance on the day of your renewal, it'll be more expensive because the insurer knows you'll probably just panic buy. The optimum time is 3 weeks before your renewal is due. The other one is Saturdays are more expensive to buy car insurance apparently, and just before Christmas is the most expensive time to buy car insurance, and that is based on the logic that you don't have any time, you're too busy with Christmas, you just need to just buy whatever and aren't going to research. So timing is apparently everything, but also so is being married. Marriage can actually reduce your premium, while having children can push them up because you're apparently distracted. And the other thing I would just add is don't overstate your mileage if you don't do many miles. And apparently the research shows that can add £31 to your premium if you basically overstate your annual mileage by 1,000 miles. So there you go, Andy. There's a quick whistle stop tour through some of the more bizarre things that actually influence your premium. And just on that before we move on, I do remember, in fact, when my wife, when she took a career break, when we had our children, when she became a housewife and said that she was a housewife, that actually pushed her premium up. And that was apparently because she'd be doing the school run, etc. They made that assumption. So, anyway, again, it's that car insurance massaging.
Yeah, well, and the last thing, don't do what I do, which is what I've done for the last 2 years, and I'm vowing not to do it this year, and that's just to let the renewal come through the post and do nothing about it and just pay whatever the renewal says. So there's a lesson. Don't do that. Good. What we got next?
Right, the last piece I'm going to just, again, go through fairly quickly, there's been a change in the way the charges for funds has to be reported. Now, the Markets in Financial Instruments Directive, MiFID, and this is actually a MiFID 2, so it's like the sequel to MiFID 1, is a directive. Sequels are never as good as the originals, apparently, but the directive came in at the start of this year, and it's from the European Union, and basically what it does is it stipulates that fund houses, so if you buy a fund, it has to give you the transaction costs that are incurred in running that fund. So before this came in, what would happen is a fund would give you their annual charge, often called the OCF. So let's say it was 1%, just to keep it simple. 1% a year would be taken from you by the fund house. But there were other charges, which are transaction charges, so the buying and selling of the shares that are within that fund that wouldn't be included in that charge. Now, they weren't hiding them. Just didn't have to disclose them. So these aren't new charges that have appeared. You've been paying them all the time, but you just didn't know. So what would happen is you'd invest, and you might be surprised at the amount that was being taken, but most people never knew. It's only marginally more, but in obscure cases it could actually almost double the charges, but mostly it just knocks it up a few percentage points, or a few tenths of a percentage, I should say. So from now on, they're going to have to disclose this charge, this additional transactional charge, on top of this annual charge. So that can add, in the worst case scenario, an extra, like say 0.5%. Some of them it's just tenths of a percent, but you could argue that if you looked overall, it's pushing charges up by sort of, in some cases, 50% or more from the fund manager. So the point of this piece is keep an eye out for those. Now, the new way of reporting this, you've obviously got the annual charge when you go and look at the fund. They only have to report this new transactional charge in addition when you go to buy the fund. So for historic stuff, if you're just researching around, they've got about a year in which they have to start showing what the transactional charges are if you want to go and do some research. But if you go to buy it, at the point where you're on your fund platform and you go through, then they have to tell you before you buy it what these additional charges are. And they can be quite significant, but at the end of the day, they're not doubling, trebling what you pay, but they are there. So it's a FYI, keep an eye out. It isn't just active fund managers, even the passives out there are having to add them. So Vanguard, for example, very popular funds, Vanguard Life Strategy funds, they are 0.22% a year, the annual charge you pay to be in that fund. There are actually transactional costs of 0.11%. So you think that is actually a 50% increase, even though in total it's 0.33% annual charge, which is still very low for a fund. But yeah, you can see if you were trying to do it relative, there is something that people don't see, but it's always been there. The one thing I would say is that, again, like all these things, it's never as simple as it should be. There's a lot of dispute about how these transaction costs are calculated. Some people are using different methodologies. There are some that actually already include it in the annual charge, and so it is really confusing for consumers, and I'm not sure it's going to help them a lot. But if you start seeing the charge, you know what it is. But my tip is focus on net performance. Net performance figures tend to exclude all fees, and so if you focus on those, then you should hopefully get more of a feel for how the fund is doing regardless of the cost. So if it's doing really well and outperforming everybody, even after its perhaps more expensive fees, then you shouldn't have to worry as much. But of course, finally, there are other fees you have to pay. Some funds have performance fees, which are where they might take a fee if they perform particularly well. They don't tend to give it back to you if they do badly. The platform you're on, so the Hargreaves Lansdown, the Fidelities of this world, will charge a small fee of about maybe 0.4%. And of course, if you have a financial advisor, he'll take a fee of up to 1% a year. So if you go do it yourself, DIY, then you don't have to pay that. So there you go, Andy. We are done.
Good. Learned a lot today, as always. Anything else to mention?
I don't think there is anything else to mention. Just review us and get in touch on Twitter the usual way, money to the masses with the number 2. And of course, you can email me as well, Damien at money to the masses. But spread the word. That's what we want.
Yeah, absolutely. And as Damien said, if there's anything that we haven't covered in the podcast that you've listened so far, get in touch with Damien, ask the questions, and I'm sure we'll be able to cover it in future episodes. Damien loves it when you get in touch because it gives, at the end of the day, we want to provide content for you, the listener, that you want to listen to. So no better way than you getting in touch and telling us what you want to hear. Right, until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.